Now that you understand what these candlesticks are telling you, let's actually learn how to place trades on the platform. And don't worry, we're still using that demo account with virtual money, so this is completely risk-free practice. Order entry panel walkthrough. First, let's find your order entry panel. It's usually on the top or right side of your screen. Here's what you're looking at. You will see the current bid and ask prices. The bid is what buyers are willing to pay. The ask is what sellers are asking for. And the difference between them is called the spread. Basic order types. Every trader faces the same challenge. How do I get the price I want when entering a trade, and how do I protect myself when I'm wrong? Trading success comes down to precise execution, getting in at the right price and getting out at the right time. To get in or out of a position, we have 3 different options we can use: market orders, limit orders, and stop orders. These 3 essential order types solve both problems and give you complete control over your entries and exits. Let's go through each one so you know exactly what they do and how to use them. Market order. This buys or sells immediately at the current market price. Click buy market and you're instantly long one contract. Click sell market and you're instantly short. It's fast, but you pay whatever the current price is. Limit orders. Limit orders let you set the exact price you want to buy or sell at. There are 2 ways to use them. For an entry, let's say you want to buy ES but think you can get a better price. Well, you place a buy limit below the current price and wait for it to come to you. For the exit, let's say you're already in a profitable trade, place a sell limit above your entry price to automatically take profit when the price reaches your target. Stop orders. Stop orders are the opposite of limits. They get triggered when price moves through your specified level and then become market orders. For an entry, let's say you want to buy a breakout above resistance. You place a buy stop above the current price, and when price breaks through, you're automatically in the trade. For the exit, let's say you need to limit losses on a trade that has gone wrong. Well, you place a sell stop below your entry price, and if price drops to that level, you're automatically out with a controlled loss. Stop losses and profit targets, your exit strategy. Now here's the critical concept. When you enter a trade, you need 2 exit plans before you even click buy or sell. Let's say you think ES is going up and you get in with a limit order at 4,500. For your profit target, let's say you place a sell limit order at your target price, maybe 4,520, where you think the move will end. The sell limit sits and waits, and if the price hits 4,520, you automatically exit with a 20-point profit. You're selling to close your buy position. Now for your stop loss, on the other hand, let's say you place a sell stop order below your entry, maybe at 4,480, where your analysis is proven wrong. This becomes a market order if price drops to 4,480, automatically closing your position to limit your loss to 20 points. Again, you're selling to close your long position. Here's something crucial to keep in mind. When you're in a position, both your profit target and stop loss orders are always the opposite direction of your entry. In our example, we bought ES to go long, so both our profit target and stop loss are sell orders. We're selling to get out of our long position. If you were short instead, both orders would be buys. You'd buy to close your short position for profit or to cut losses. Now remember, buy in, sell out, or sell in, buy out. Whether you're taking profit or cutting losses, you always use the opposite order type from how you entered the trade. And yeah, no, this trips up a lot of beginners, so double check your order direction before hitting submit. You don't want to accidentally double your position when you meant to exit. Trust me. Always set your exit orders prior to or immediately upon entering your position. It removes emotion from your exits and forces you to define your risk before you're in the heat of the moment. Position management details. Once you're in a trade, you will see it in your positions section. You'll see your entry price, how many contracts you have, and your current profit and loss in real time. To close your position, you can click the flatten button to close everything immediately. The flatten button is kind of like your emergency exit. It instantly closes all your open positions with market orders. Think of it as the panic button that gets you completely out of the market in seconds. Now, if you're long 2 ES contracts and 1 GC contract, hitting flatten closes everything immediately at whatever the current market price is. Just remember, flatten uses market orders, so you might get filled at worse prices during volatile moments. It's designed for speed, not precision. Use it when you need to exit quickly, but for normal trade management, closing individual positions using limit and stop orders gives you way better control. Partials. Once you're in a trade, you have options beyond just hitting the flatten button. You can close part of your position, so if you're long 3 contracts and want to take some profit, sell 1 contract to reduce your risk while staying in the trade. We call this taking partials.
Order filled.
You can also move your stop loss as the trade goes in your favor to lower your overall risk. We call this trailing your stop loss. Now, some of the best traders in the world use these 2 tricks to maximize their winners and cut their losers before they get out of hand. Account monitoring. Let's talk about the 3 most important numbers you need to watch in Tradovate. Look for your account panel. It's usually in the top right corner, or you can click the account tab to bring it up. This shows your total account value right now, including any open positions. If you started with $50,000 and you're up $500 on an open trade, your balance shows $50,500. This number moves in real time as your positions gain or lose value. Buying power. This shows how much margin you have available for new trades. Here's where futures get interesting. One ES contract might be worth $250,000 based on the current index price, but you only need about $12,000 in margin to control it. That's because you're using margin to control much larger contract values. That's roughly 20-to-1 leverage. This is incredibly powerful because a 20-point move in your favor on one contract equals $1,000 in profit. Now in Tradovate, you can also see your open P&L right in the positions tab. This shows you exactly how much each open trade is making or losing in real time. Watch these numbers closely, especially when you're learning, because they teach you how quickly things can change in leverage trading. Position sizing guidelines. As a beginner, always start with 1 contract until you're consistently profitable. Don't let the leverage tempt you into overtrading. Even with a $50,000 demo account, treat each contract seriously so you build good habits before you switch to a Tradeify account. This is incredibly important because otherwise you're going to lose a lot of money. Common beginner mistakes. Watch out for these rookie errors. Accidentally clicking buy instead of sell, forgetting to cancel unfilled orders, and entering positions without stops. But if it still happens that you place an order by mistake, look for the cancel button in your orders panel immediately. Alright, you now have all the essential skills to place your first trades. You understand market orders for instant execution, limit orders for precise pricing, and stop orders for breakouts and risk management. You know how to monitor your account balance, daily P&L and buying power, and most importantly, you understand that whether you're long or short, you always exit with the opposite order type. Now take some time to practice these mechanics on your Tradovate demo account. Place a few trades, set profit targets and stop losses, and get comfortable with the platform's interface. Remember, muscle memory matters in trading, so the more familiar you become with order placement now, the smoother your execution will be when real money is on the line. In our next episode, we'll add some powerful tools to your trading arsenal. We'll cover the essential indicators that professional traders use, moving averages, volume analysis, and VWAP, and we show you how to combine them with the price action skills you've learned to identify higher probability trade setups.